Good afternoon, everyone. This is Sam Agresti with Brady Ware Dealership Advisors, and I want to welcome everyone to our monthly webinar. This month, we have a really good topic. I think with a lot of the tax changes that we've saw through a lot of the legislation this year, and just some of the changes in the dealerships with inventory levels and things like that. And we thought it'd be a good time to do a little mid-year tax checkup. And today we have Matt McKinnon, who's a tax partner in the Columbus office, who's worked with dealerships for several years. Going to walk us through some of the key things we should be thinking about as we're in August here already for 2020. And with that, I'll turn it over to Matt.
Great, thank you, Sam. Appreciate the introduction. Good afternoon, everyone. Again, my name is Matt McKinnon. I'm a director here at Brady Ware in the tax practice, and been working with dealerships and serving those clients for pretty much most of my career. So thought we would take the time today and sort of revisit a few tax concepts that are dealership specific, some new stuff that's come out in 2020 that may be relevant to your business, and just some helpful reminders on a few topics. So we're going to cover 5 main areas today. We'll talk a little bit, brief refresher on the Tax Cuts and Jobs Act, that substantial legislation that was passed in late 2017. We will hit on the CARES Act, which was one of the few pieces of legislation that came out in response to the pandemic earlier this year in March. We'll address some things that we're seeing in the industry from some of our clients and just chatter around the industry. So, developments and the potential tax impact of those developments. Fourth topic, we'll hit on just a brief reminder of some of the specifics around cash transaction reporting, real fun stuff that I'm sure we all love dealing with. And the last thing we'll touch on today is just some reminders and updates with respect to state and local taxes, and specifically we'll focus that on Ohio. So first thing we'll go through is we'll go through a high-level refresher on the Tax Cuts and Jobs Act. So the 4 really relevant provisions here that I think are worth mentioning again relate to tax rate reductions. Obviously, this is for individuals when the dealerships are operated in a pass-through status, either an S Corp or an entity taxed as a partnership. And obviously, there's a tax rate reduction for C corporations as well. Next area we'll talk about the qualified business income deduction limitation, just the deduction availability. There's a nice 20% deduction there. Then we'll hit on the interest expense limitation, and we'll wrap up our refresher on the TCJA, talking about all the favorable depreciation provisions. So first off, tax rate reductions were a big piece of the TCJA. The Trump administration wanted to get tax rates down, obviously to stimulate the economy further, and he did that. The top tax rate went from 39.6 down to 37% for individuals. So and we'll talk about the qualified business income deduction here in a moment, but that 20% deduction, which is 9 times out of 10 available for dealerships, actually takes the top effective tax rate on that income down to 29.6%. So a huge change from years prior to 2018. And I think something to note with respect to the income tax rates for individuals, the top bracket for married filing joint, just using 2018 as an example, the top bracket was increased dramatically. So your owners of dealerships aren't hitting that top tax bracket and getting into that 37% until they have more than $600,000 of taxable income. Before, it was down at about $480,000. So, you're looking at a significant increase in the bracket to get in the top rate and a tax rate decrease. So, a big change. C corporations, it's a flat 21% now. We don't have too many dealerships that operate in C Corp status, so I'm not going to spend a lot of time on that. Second area of note would be the qualified business income deduction under Section 199A. This is generally available for trade or business income of pass-through entities. It's not available for C corporations because they got the preferential tax rate of 21%. If you have a business that is a professional service, what the IRS terms a specified service trader business, doctors, attorneys, CPAs, we obviously get hit with that. We're not eligible to claim this, but dealerships are. Generally dealerships will be able to get this benefit. So we'll talk again about how that top tax rate gets down to that 29.6 effective number with this deduction. So it's a 20% deduction against what the IRS calls qualified business income, which is essentially taxable income. And that limitation is, the deduction is limited to the lesser of 20% of your qualified business income, 50% of the W-2 wages paid by the dealership to all employees, or in the case of a real estate entity, this was sort of added at the last moment. Surprise, the administration has a significant interest in the real estate industry, that the limitation is 25% of W-2 wages or 2.5% of what they refer to as unadjusted basis of assets immediately before the calculation. So, if you've got a real estate entity, obviously there's probably not a lot of W-2 wages being paid, but you've got substantial fixed assets, and the calculation is determined using those. So just for a dealership's perspective, let's talk about an example where you may have $1 million of qualified business income. 20% of that would be $200,000. So your first step would be, okay, my deduction may be $200,000. If the dealership paid $500,000 in W-2 wages to all employees, 50% of that would be, that 50% limitation would be $250,000. So in this case, the deduction is the lesser of those two, or $200,000, which would be your 20% of QBI figure. So that's kind of how it works. So effectively, the individual owners would be paying tax on $800,000 of income from the dealership. And just, when we're talking about this, obviously this is a huge provision for pass-through dealers, but C corporations have always been subject to what's called double tax, that the corporation pays tax on its profits, and then when the profits are distributed to shareholders, the shareholders have to pay tax on the dividend distributions to themselves. So that's always been the downside of a C corp. So there's still that analysis that at least needs to be considered, whether the business should be a C corporation or a pass-through. We got those questions quite a bit when this first came out. So the QBI deduction here helps to in that analysis. So I think it's worth mentioning now. Rental real estate activities, these may or may not qualify for qualified business income deduction. If it is if it's a standalone single purpose entity that the owners of the dealership have put the real estate that the dealership uses in a standalone partnership, and they're leasing it to the dealership, there's rules out there. To the extent you have common control, et cetera, there are a lot of qualifications that you can aggregate these together for purposes of computing this deduction, so it would be eligible. Some real estate activities are not eligible, but that's sort of beyond the scope of this. But generally speaking, in a dealership context, if you have the operating entity of the dealership and you have a standalone real estate entity that's its single purpose and they're just activity back and forth, that would qualify for this deduction. Next area is the interest expense limitation. So if you have a dealership that has gross receipts of more than 25 million, you're potentially subject to this limitation. If your dealership isn't, or you have multiple dealerships, if your dealership does not have more than 25 million, but let's say you have 2 or 3 that all file separate tax returns, you have to consider all of those affiliates as a control group for purposes of determining these receipts. So let's say you have 2 different points, they're in different legal entities. One's got 12 million in receipts and the other's got 20 million. Individually, they're not over that, but the rules for this say that you have to aggregate those because they're affiliated. So you would be over the threshold and you'd have to at least see if you meet the requirements for this limitation. So interest expense can be limited, the deductibility of it. It's to the extent interest expense exceeds 30% of your adjusted taxable income, then you may have a limitation. Now, what is adjusted taxable income? It's effectively EBITDA. So if your interest expense exceeds that, you may get limited on that deductibility. The portion that's not deductible is carried forward into subsequent tax years. However, there are two additions here that have to be considered. You're always allowed to deduct interest expense to the extent you have interest income. So if, let's say you exceed your 30% limitation, but you have interest income, you can always add that on and you get to increase the amount of interest that you expense that you can deduct. There's a nice provision out there regarding floor plan financing that was statutorily determined that that's always allowed to be deducted as well. So really the only interest for a dealership that could be subject to limitation is something other than floor plan interest. So there were concerns when this first came out that dealerships were not going to be eligible to take bonus depreciation, which we'll talk about when we get to the depreciation provisions, that because dealerships, if you had floor plan interest, whether or not you even were limited, if you had floor plan interest, you weren't eligible to take bonus depreciation on your fixed assets. Well, this was addressed in regulations last September 2019 that said now dealerships can claim bonus depreciation if all business interest expense, including the qualified floor plan interest, does not exceed the limit. And I wanted to note here that when this change, this limitation came out with the Tax Cuts and Jobs Act, the percentage was 30%. We'll talk in a moment that the CARES Act increased that to 50% of your adjusted taxable income. So the threshold was higher, so you basically had more room on which to calculate whether you were limited or not. So that's why it mentions 50% here in that first bullet point. So the extent you have $1 of interest expense over that 50% limit, you cannot take bonus depreciation in that tax year. That tax year stands on its own. If in the subsequent year you're not subject to the limitation, then you're allowed to take bonus depreciation in that subsequent year. And there were also concerns that, okay, if, when these regulations didn't exist yet, well, what if I have a related real estate entity, like we talked about a moment ago, and I do an image upgrade or some other type of substantial improvement that could have been eligible for bonus depreciation, but I've got an affiliated entity with a dealership that's at that time not allowed to take bonus depreciation. Can I take it on this real estate affiliate? Well, this proposed regs came out and suggested, well, they actually clarified that the related real estate entity is eligible to take bonus depreciation no matter whether or not the dealership is subject to the limit or not subject to the limit. So the final area we'll refresh with respect to the Tax Cuts and Jobs Act relates to depreciation, bonus under 168K, and the asset expensing election under Section 179. So bonus depreciation, this has been around since 9/11/2001 in various percentages. The biggest change here from the Tax Cuts and Jobs Act relates to the fact that bonus depreciation now applies to used assets. Previously, it was only new. You had to be the person who's placing this piece of property into service for the first time ever. So the percentage that's available is 100% through December of 2022. Then it starts phasing out that for tax years 2023, it's at 80%. then 60, then 40, then 20, and in 2027, it's no longer available. So as we mentioned, dealerships are eligible to take bonus depreciation now, as long as there's no interest expense limitation. Section 179, again, another accelerated way to write off the cost of property, plant, and equipment assets, dollar for dollar in the year acquired. The deduction is going to be $1,040,000 for 2020. However, the spending cap on those type of assets that are eligible for that deduction cannot exceed $2.59 million. If they do, then you start losing that $1,040,000 deduction dollar for dollar, by which your additions exceed that. Unlike bonus depreciation, you have to have taxable income to use the Section 179 deduction, so you cannot create a taxable loss with it. Bonus depreciation, you could create a substantial taxable loss. That's not a problem. And a big change with Section 179, generally this was used for your short-lived assets, your 3, 5, 7-year tangible property, furniture, fixtures, service equipment, that kind of stuff. It was clarified now that you could use Section 179 for certain real property improvements, things that were typically ineligible. So if you have a roof replacement, you change your HVAC system, you add an alarm system, security, etc., you're now eligible to use Section 179 for those real property improvements. Okay, let's move on to the CARES Act from March of 2020. Really 4 main relevant provisions here for dealerships. We'll touch on a change to the interest expense limitation. There was a correction to the qualified improvement rules for the depreciation provisions. This is a huge change. Net operating loss changes for dealerships that may have a taxable loss. This is relevant. And then in conjunction with the PPP loans from the SBA, there was a payroll tax deferral that was allowed. So interest expense limitation, the only change here in the CARES Act is the applicable percentage. So it was increased from 30 to 50%. So your interest expense has to exceed 50% of your adjusted taxable income before it's limited. That's for 2019 and 2020 if you're an S corporation. If you're a dealership that's taxed as a partnership, it's still 30% for 2019. You get the 50% benefit starting in 2020. The biggest change that happened as a result of the CARES Act that practitioners and taxpayers alike were both waiting for, it relates to this qualified improvement property correction. Historically, before 2017, qualified improvement property was considered a 15-year depreciable asset and eligible for bonus depreciation. Qualified improvement property, basically like leasehold. So certain improvements to the interior of a building, non-structural, things like that nature. So, you build out a new office within a dealership and you're not changing the exterior structure at all, you're just refreshing the insides. That would all generally be considered qualified improvement property. So in the past, it was 15-year asset and eligible for bonus. Well, with the passage of the Tax Cuts and Jobs Act, there was an error in the drafting that somehow got rid of that 15-year classification and now made it deemed a 39-year asset and ineligible for bonus depreciation. Well, because it was a drafting error, the IRS couldn't change it. It had to go through a technical correction. It had to be passed as legislation. The IRS couldn't just change it on their end. So this had such a widespread impact to various industries, dealerships, obviously, restaurants, things like that. It was called the retail glitch. So the CARES Act changed this to 15 years. So that makes it now eligible for bonus depreciation. To the extent you had things that would qualify as QIP prior to So say in 2018 that you had to treat those as 39-year assets, there are techniques out there to catch that up on a cumulative basis and take those missed deductions in either 2000 on your 2019 or 2020 tax returns as an adjustment all in that year. So let's say you put $500,000 of QIP into service in 2018 and you were able to take 1/39th of that as depreciation. If you haven't filed your 2019 tax return, you could claim now a catch-up deduction for, let's say, $480,000, whatever that differential is, the total less than 1/39th. You get that all as a tax deduction in 2019 through a tax method change. It's a separate form the IRS prescribes, but a great thing to make sure that you're getting the benefit of if you have this with your specific dealership. Net operating loss changes. Prior to the TCJA in 2017, if a dealership had a net operating loss, that loss, the owners could take that tax loss back 2 years and then carry it forward 20 to offset either previously reported taxable profits or future profits. The TCJA eliminated the carry back period. You could only carry it forward. Now it's indefinite rather than 20 years. And you can only offset up to 80% of your taxable income, the dealer's individual taxable income, in a given year with that loss. And to the extent your losses from the dealership, you can only use up to 500,000 of those against non-business income. So let's say wages, investments, et cetera. So there was this second, I guess, limitation that was provided for in the TCJA. Well, the CARES Act was great. They got rid of the carry forward only provisions and said, okay, now you can carry losses back 5 years and you can now continue to carry them forward indefinitely. So this allows, if your dealership had a taxable loss, you could go back to as far as 5 years back and capture profits that were paid at arguably 39.6% rates. So great incentive if you're actually in the position of having a taxable loss. And that $500,000 non-business cap, that was eliminated as well. If you got hung up with that in 2018, the owners on the 2019 return could take that all in 19 and free it up and allow it as a deduction. So payroll tax deferral is the last area of the CARES Act that we'll talk about. Basically, because of the pandemic, there was an opportunity to defer employer payroll tax expense. So the employer FICA for any wages paid from March 27th through December 31st, 2020. The nice thing here is it would give you the ability to pay half of whatever you defer during that period by the end of 2021, with the remaining half that was unpaid due by the end of 2022. There was some concern originally when this provision came out that if your business was obtaining a PPP loan, that you could defer this payroll tax until such time that your PPP loan was forgiven. And then after that time, you couldn't defer any more payroll tax. However, it was clarified that even if the loan is forgiven, taxes can still be deferred. So no matter the status of your PPP borrowing, any payroll employer taxes, if you make the election, you could choose to have those deferred until 2021 and 2022. Okay, so let's quit talking about tax legislation for a bit and talk about some more, I guess, relevant and current topics. So things we're seeing in the industry from our clients and just from conversations from other colleagues in the dealership space You know, this pandemic's caused a real decline in inventory levels. So we're seeing inventory levels of clients drop considerably. If it still exists at year end, you may have possible LIFO recapture because your inventory has gone down if you're using LIFO. Obviously, if the administration changes, we could have potential tax rate increases in possibly 2022. With respect to the PPP loans, you know, we got to make sure we're taking this into account for tax planning. The loan forgiveness itself is statutorily deemed not taxable income, but the expenses that you paid with those loan proceeds are not deductible. So you're likely going to have expenses you've had in prior years, and you're not going to be able to deduct them in 2020. We're seeing the IRS have an initiative with micro-captive techniques, and they're actually sending out a second round of taxpayer letters to try to stop certain insurance initiatives. All of our dealer clients have at least received the first round of these. If you have an F&I reinsurance arrangement, we don't believe that their initiative is targeting those type of arrangements. But we just want to make you aware that the IRS is continuing to send correspondence on this. If you receive it and you have questions, please reach out to your Brady Ware advisor. Just a quick reminder on cash reporting requirements. The IRS issued some guidance, or just like a news release in July reminding of this filing requirement exists, reminding, I'm assuming they're going to start looking at it a little bit more and potentially do some audits. You can e-file these now as opposed to the paper filings. You have to have an account with the FinCEN's BSA e-filing system. You can do that all online. Probably makes this easier to file. You can do it individually, or you can do them in batches if you have multiple transactions to report. Just keep in mind that this has to be filed within 15 days of the cash transaction. And there's a link here for the fact sheet that contains some reminders of the general requirements for the Form 8300 filing. You know, it's cash payments that exceed $10,000. We won't go into those details. Since the IRS revisited it and sent out some news releases on it, it's obviously something that's on their mind. So I think dealerships can have this, so it's relevant to talk about. The last thing we'll touch on briefly is state and local tax from an Ohio perspective. We're seeing some use tax audit activity. So, you know, you got to make sure, is your dealership, do you have a use tax account, and are you filing returns? Considerations on some things that are subject to use tax would be when you pull inventory items that have not had sales tax paid on them and you use them in a taxable manner. So if you've got demos for sales folks or for owners, that use of those vehicles is subject to use tax. If you're providing service cars to customers for no charge and it's not a warranty issue, then there could potentially be use tax on that as well. From a commercial activity tax perspective, I think the big thing we're seeing here is, if you have a bunch of affiliated entities, have you chosen the correct filing status and methodology? So were you registered correctly, whether it be combined or consolidated filing, in order to take advantage of the various rules there and minimize your tax? And obviously making sure there's very little that's excluded from Ohio commercial activity tax, but there are certain exclusions from gross receipts applicable to dealers. You got dealer to dealer trades, internal sales, manufacturer payments only if they're paid directly to the dealership. These are deemed purchase price adjustments or reductions of the cost of the vehicle. If they're an incentive paid to the customer, that is still taxable to the dealership. And then certain reimbursements like holdbacks, other things, those are excludable, and you shouldn't be paying Ohio CAT on them. So thank you for your time today. Hopefully you found this useful. If you have questions, my phone number, email is listed on the last page. Please feel free to reach out. I'm happy to help any way possible.
Thank you, Matt. A lot of information there. I think, like I said, there was a lot of legislation. A good time to do a little refresher, especially with some of the new legislation. And Matt's contact information's there. We knew there's a lot of information. So if you have questions, feel free to reach out to Matt. He'll get back to you. And we'll wish everyone staying healthy and safe out there, and look forward to our webinar next month. So take care, everyone. Thank you.